What's up, guys? I'm coming to you straight from Korea over here in my father's office, celebrating his 90th birthday, which is a trip because the guy is as healthy as ever. And you know, every episode I start off by saying this week couldn't get more crazy than the last week. And that trend continues because last week was just as crazy a week as we've ever had. Now, if you've been following me on our Discord channel, the FoFty Discord channel, I had given a pretty stern warning on Thursday. It was that the SDSI, which is this proprietary indicator that I created, SDSI is a funny short acronym for super duper secret indicator. This thing had activated on Thursday and it went up pretty high. And basically the way this indicator works is if it goes above this purple line, that is a signal that is about to get triggered. And what happens is the trigger confirmations happens when it goes up and then it comes back down. And that peak, like the peaks we've had before, are generally triggers that it's signaling a huge directional changes, maybe a day or max 2 days away from occurring if that trigger happens above this purple line. And we went up above it on Thursday. And so when that happened, I kind of, I posted on our Discord server that this had, watch out, right? We're going to be, facing a pretty big momentum change in the direction. And we had been going up until that point. So obviously the direction would be down. And I also said, a couple of days before that, there were other indicators. And, I just wanted to say, like, we think that the news drives the market. And yes, there are news spikes like Trump saying something or, but those are short-lived spikes. And, what really happens is that there's a lot of underlying technicals in the market that are already happening underneath the scenes. And we're basically just waiting for some kind of a news event a lot of the times that we would like to blame whatever happened in the market on or try to justify whatever the market did based on that news event after the fact. And it's it's the same thing as we do with Monday football quarterbacking, where after the game we say all kinds of stuff. Same thing with stock market. Is a lot of it is actually, there's a lot of these signals in the internals of the market that are telling you what's going to happen. And it's basically people are positioning for it and they're just waiting for the trigger. And then whatever the trigger is, they're going to just attribute that to the market movement after the fact. And that's the way things usually work, which is no different than in this case. And in this case, on the 11th, so even days before that, I was saying, look, we have all these signals coming up. And we'll find out soon enough what the news will be when we'll, Monday morning quarterback and retrofit the news to explain what happened in the market. And I was warning people on the Discord server that that was going to be happening soon. And also, that we had triggered the SDSI as well. And so, the next day, we had a pretty big down day. And obviously the news is the Iran-Israel war that erupted and the bombing that Israel did on Iran strategically. Now, I bring this chart up because I want to show you when the SDSI was triggered over here. So here we got the confirmation signal and it went back down. So we had a peak, which I highlight in yellow circles here. The last time we had a peak, and it just eked out a peak here above the purple line over here, was back in April. And that signified that, we were going to have a directional change, a pretty big one. And the signal came about a day early because we continued to go down the day after. But 2 days after, we had that massive reversal, and we just shot up straight all the way up to where we are now, and we've just been meandering in this distribution mode ever since then. And so the last signal that the SDSI triggered resulted in this massive move up. And then if you look at the last time it triggered, when it went above the purple line, it was all the way back in February. And back then, that trigger where it went up and spiked down, causing this trigger, essentially foretold of the start, basically, of the crash, right? And we crashed pretty hard after this was triggered. The other trigger that I didn't count, but is pretty close to the purple line over here, it just missed it, but close enough, was when we actually had the reversal back here. So it triggered and it foretold of this counter move rally. So, this SDSI alert that I created actually does pretty well. It doesn't, so there are moves that it didn't capture, right? Like it didn't capture this bottom, so it doesn't capture every single directional change, but conversely, what it does is when it does get triggered, it's pretty accurate in foretelling in the next 1 to 2 days that there will be a pretty big directional change coming our way. And so when it does trigger, I always pay attention. And while I don't share the internal mechanics and functions and calculations and data inputs into this, I do share the trigger with my Discord server friends, so they got the notice on Thursday when it triggered, and then on Friday we had that pretty big drop because of the bombing that Israel did on Iran. And now looking into the weekend, we can see the escalation happening, and I'll talk a little bit about what I think is going to happen next week, basically due to the war that is basically staring at us in our faces. Now, when I talk about the other signs that were being, put to the forth by the market, the other one was the DeMark count. Now, if you don't know what the DeMark count, he has a 9 and 13 count, and I'll put the link to the DeMark count in the description. If you don't know what it is, it's actually worth a read. It's not a perfect signal, but it's a pretty good one, and it's something that some of the more sophisticated traders actually take a look at if they don't follow it completely. And that actually resulted in a 9 count completion earlier in the week, followed by a 13 count completion. So we had a completion of both the 9 and 13 count on the ES, meaning the S&P futures, which is what I follow because of the continuity it has in its price structure, which eliminates a lot of the gaps that the cash SPX market and ETF SPY has, which I think conflates and confuses the data. And so we actually had both a 9 and 13 count complete last week, which I also warned in the Discord server saying, look, we're probably, that's it, right? We're probably going to start having a change in direction, and direction had been up, and we're probably going to start going down as a result of that. And lo and behold, after the 13 count completed, we had the beginning of a couple of red days leading into the Friday close, which was a pretty bad day because of, again, the Israel-Iran war. Now, if you look over here, the last time a 9 count completed, we had a small correction, and the last time a 9 count completed back then, we had a pretty big correction. So again, this 9 count and 13 count, nothing's 100%, but if you start to layer in things that are pretty accurate over each other, and then in a netted out combined point of view, they all point to the same thing, then the chance and the odds of that same thing being actually correct goes up, right? And so while no single indicator is going to be 100% correct and tell you what's going to happen, when you know which ones that are that matter and are important, and you layer them on top of each other, and then it's like corroborating witnesses who don't know each other pointing to the same suspect in a courtroom, then the chances go up that that suspect is really the suspect, right? Especially when you have uncorroborated witnesses who don't know each other saying the same thing. Well, it's the same thing with these signals when the market internals telling you that there are these different ways of taking a look at the market internals, completely different methods, price action, momentum action, volume action, so on and so forth, and they're all start saying the same thing, then you know that the thing that the market internal indicators are telling you they're saying the same thing, then that thing is probably correct. So this is another one of the things that I saw that I said, hey, look, the count's completed, plus I had the SDSI trigger at the same time. This is looking like we're going to have some kind of a top here and start going down. The other thing that I also was looking at was, this rising wedge I've been tracking for many days now. This is on the daily time scale, so each one of these bars is a day. And we had been building this rising wedge. Now, again, no pattern is 100% correct, but this looked to me like a pretty well-formed rising wedge with many, many touches here. We had one touch here, touch here, touch here, and then multiple touches here, and on the top we had multiple touches up here. We had a kind of pseudo top here and multiple touches over here. So this to me was a pretty well-formed wedge, right? It's not one of those like it's only one touch and you're like, yeah, it's a wedge. No, this had many, 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 many touches, and it was compressing. And obviously in an ascending wedge, the pattern would be that we would go down, right? The resolution is down, and this was on the Qs, and that's what I was watching. So then yet another corroborating witness telling me that we would have a reversal very soon. And the result of that rising wedge, as we can see here in the Friday session was we broke down out of it, and it was a pretty solid breakdown out of it. And then we went back up to retest it and got rejected, which is why it went all the way up to the lower rising wedge trend line, and then got rejected, and we ended down in the day. So this to me is a very clean break of the ascending wedge to the downside, which confirms again one of the corroborating signal indicators of the market internals. Finally, I want to bring up the other thing I was watching, which was, again, this is on a daily scale, so each bar here represents a day trading session, is a Ballinger Bands. Now, the Ballinger Bands tell you a few things, and what I use it for is that, whenever the bands start to compress, right, meaning like they're getting closer. So it had expanded quite a bit when we had this huge downturn. And so it became wide open, right? And then ever since we had our recovery, the band started narrowing together to the point where it was actually really narrow up here. So we went from a large expansion to a very compressed, narrow constriction of the Ballinger Bands, basically because we were just trading in a narrow range for a while, which I think was essentially a distribution by the institutions to the retail traders, as I'll show you in a bit. But basically, when we start constricting like we had over here, the last time we were very constricted, that means something big is going to happen, because all the compression is going to result in an explosion and the bands are going to open up again. And that's what happened the last time in February when we started having the market crash. And lo and behold, it opened up again and constricted around here, and then we had that big crash and open up again. So we were constricting here. I'm saying, hey guys, we are probably going to have a big opening of this Ballinger Band, and the direction is likely going to be to the downside. And the reason is we were hugging the upper edge of the Ballinger Band. And if you know Ballinger Bands, you don't really go much further down from it. Even in a crash, these crash, we'd go down, but we'd stick around the Ballinger Band. You don't really go out of the Ballinger Band, because that's the way the bands are calculated. And so what you might do is you might hug it, but then when you hug it, then you're going to go to the other side. And we were hugging it over here, and we actually pierced it, and it was constricted. So when you pierce it after the expansion, so like here, right, it expanded, and then we started going down. We started going. That's a different story than it was going here. We were tightening it up, and we're in the tightening up. We were hugging the top. So that means when it expands, it's probably going to go to the other direction. And so that was the other corroborating signal to me that, hey, we're looking at a top here. This could be, and if you've been following in my other episodes, the end of the return to normal, which is where everybody gets complacent again, and we think we're going to make a new all-time high. Everything's okay again. Nothing ever happened, and then we either come close to making an all-time high, or we basically fall short of it, and we basically start dropping again. And I think that's essentially what happened here, is everybody got lulled into a sense of complacency after the Trump tariff shocks, and thinking that we're going to make all-time highs. And the market internals was telling us that that's not going to happen. Now, the last thing I'll show you that was, to me, a clear signal that we were looking and facing at a big directional change and to the downside after bouncing back up from the tariff lows, was the VIX. Now, the VIX had this really long trend line that was developed since last year, and I'm not going to draw the whole thing, but essentially we kind of had this breakdown the past week of the VIX trend line. And I kind of see why people say, hey, you can't do technical analysis or something like the VIX. But if I show this chart, we had respected this trend line over and over and again, going all the way back to September. December of 2024, going into all the way June. So that's almost, like 3 quarters, right? And I said that this is likely going to be a false breakout, because if it was a true breakout, and knowing how VIX moves, which is huge changes, we would have a true breakout, would have a huge move to the downside, probably down to like 15 or something. And we never did. We just hung around and hugged it. And that to me was another signal, given the other signals that I was showing you, that we're probably going to have a big directional change heading our way. And essentially on Friday, now it went back down, went back up again when I took the screenshot. But the point here is this trend line gave a trampoline bounce to the upside. And what is most likely going to happen now is we're probably going to have an upside week to the VIX, given the geopolitical situations and news excuse now we have to sell off, essentially, with the markets. So moving along, let's talk about what's going to happen now. So on the Dow Jones, the bad thing is, with what happened basically on Friday, is that because of Friday, if you look at this, we closed below the 200-day moving average. Closing a daily bar under the 200-day moving average is never a good sign. Like the last time we did that, that kind of signaled that we're going to go down here. And we tried to go up, we went down, we went up, but again, we failed to really clear. This to me it's looking like a failure to clear the 200-day moving average on the way back up, right? We went up, failed, we went back down, and we had another boost to get up, but we didn't really clear it, right? What we did was we just kind of meandered here in a more distribution kind of mode, and I'll get to that, before heading back down, and then worse, solidly closing back down under the 200-day, which is really not a bullish sign. And to me, this overall structure here is very bearish. It's essentially telling me that this indeed was a bear market rally, that this was a big distribution sequence of money unloading from the institutions to the retail traders who FOMO'd in and bought the dip. And now that we have closed underneath back at the 200 for the second time, actually the third time here, fourth time, fifth time, but this one looks like a solid breakdown. To me, this looks technically like we're probably going to be heading down, and this may have been it, right? This may have been the top of the counter trend rally, bear market rally, ever since we chopped and hit the market lows back in April. Let's look at other points of data of what's really happening in the market. So if you look at this chart, it is clear that we are all into the market. So this chart, what it's telling you here is that we are at an all-time high, right? All-time high in terms of equity allocation. So the amount of money in your portfolio that has been put into stocks is at an all-time high, higher than the previous high, which was in the dot-com peak. This means everybody, and here, it's across all types of investors, individual investors, mutual funds, pension funds, foreign, it doesn't matter who you are. If you're an investor, the bulk of your money is now in equities, not in debt, because of the whole interest rate issue, and also cash has kind of been there. So basically people have been dumping their money into equities, FOMO buying the dips, right? Like a well-trained Pavlovian dog ever since the bottom we had in April. So we are all into the equities, right? And you'll hear a lot of things like, hey, there's a lot of cash sitting on the sidelines. You know, there's a lot of money, dry powder that's going to come in and make the, this is the narrative that people will putting up, that we were going to have a new all-time high because there's so much cash sitting on the sidelines. I'm not going to show you the chart, but there is a money market chart that shows you that, in fact, yes, indeed, the money market is at an all-time high from a notional point of view, and that represents a lot of dry powder for investors to take and move into stocks, which is why we could yet see a huge run-up blow off top, as they've been calling it, into a new all-time high from all that cash into stocks. But that's actually wrong, right? What you need to look at is the percentage, right? Available cash as a percent total of the total market cap, because that is really what determines how much cash is on the sidelines, not the notional value. And you need to understand this. Otherwise, you're going to listen to the wrong, social media investor Furu, who's going to show that chart, and you're going to be misled, right? The correct thing to look at is the percent of total, and the percent is really low, right? Which coincides with the other chart saying everybody's in. We're all in. So we are at a situation now where a lot of the cash is not available. They're all into the market already. They're just, from a percent allocation point of view, we're all in already, right? There is no huge amount of dry gunpowder waiting to just go in and chase the prices up. That is an incorrect way to look at it, even if the chart shows you, and you got to understand what the chart's saying. Now, there's another war going on besides the war between Iran and Israel, and that's the war between institutional clients, basically the big boys, and the retail traders, basically you and me, the mom and pops. And what's been going on is the institutional money, the big money, the sharks, the hedge funds, the institutions, the mutual funds, the fund of funds, and all the big institutional asset managers have been unloading, right? Their flows are negative since mid-May. And if you look over here, they've been basically negative this entire run up. Negative meaning they are selling, they are unloading their stocks. Whereas the retail or private clients, and this is Bank of America securities, right? their retail clients have been loading up, buying the dips. So essentially, every transaction, there's a buyer and a seller, right? So it is exceptionally clear here who's doing the selling and who's doing the buying. There is no question. The sharks, the institutional money, right? The sharks, the big money, the hedge funds, they are unloading, they are selling, they're negative, right? Whereas, and who are they selling to? They're selling to the retail money, the mom and pop traders, the stimmy check traders, right? The Joe Blows who think they're going to become billionaires because these people have been the ones who are buying. So that's the way we've been structured ever since basically the bottom in April, the interim bottom that we put in. It's retail people buying, 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 and they're buying it from whom? From all the sharks, the big money, big asset managers, institutions have been selling, selling, selling. Now you got to ask yourself, in this war, who's going to be, correct? And I don't put my money on the retail traders. And the reason is simple. The reason, retail people, you and me, we don't have access to information at the speed and scale that the institutional big money guys are. They have inside access to information, trust me, because they're managing billions of dollars, right? They're not looking at some stupid news feed from Bloomberg terminals and all that you and I can pay and get access to. No, they have access because they have phone call talks, right? Phone conversations with people up in the government, people up in other markets like who own $1 billion, who heard from other. That's what they have access to. And when they trade, right, they're trading for the long term. And I think they've just been selling to the retail people who have just been dumb buying FOMO, chasing, buying the dip. And I think now is kind of the end based on the indicators I've shown you, essentially, especially the SDSI, which has shown all the big changes, the first drop, then the big rebound, and now it triggered again for another big drop, which is probably going to be commencing now. And that's why this episode is called The Beginning of the End. That's what's been going on. And, we'll see how it plays out, but my money is not on the dumb money. My money has always been on the smart money. The smart money is also in the bond and currency markets where retail people don't really trade in, because in order to make a lot of money in the bond and especially the FX and currency markets, you need a lot of capital, right? Because the increments are a lot smaller there in terms of gains and losses. So the reaction of the dollar is also something I want to bring up here. So when the war broke out, you would think that the dollar would just skyrocket, right? Because traditionally, whenever there was a risk event, two things always would happen. Well, three things. The first thing that will always happen is the dollar would skyrocket as everybody would scramble for the dollar as a safe haven asset, right? And the other thing that would happen is the yields would plummet as everybody would try to buy U.S. treasuries, U.S. debt, basically, because those two things were considered really safe. Because the U.S. is not going to go away, right? If there's a war, if there's some, if aliens came or anything like that, COVID, dollar goes up, treasuries goes up, and yields go down. That's always been the case, right? Almost always. But what we saw in the attack when Israel attacked Iran was the dollar actually kind of collapsed, right? Which is, well, why is the dollar struggling to go up? This is a very strange behavior. Dollar should just skyrocket, but that didn't happen. And some people are trying to say, well, this Israel attack on Iran isn't really a safe haven asset. No, it was. It was absolutely, because if you look at all the other times there in the Middle East, including other times Israel attacked Iran or Iran attacked Israel, the dollar would skyrocket, right? But not this particular time. And this coincides with the other behavior we saw, where when the market crashed in February, the dollar didn't go up, and neither did the bonds, right? The yields went up and the dollar went down, which was the beginning of a sign of saying people don't believe in the U.S. as a safe haven asset play anymore. They don't, right? And this is confirmation. We first saw that with the crash in February, and now we're seeing it again with the Iran-Israeli war. The initial reaction here is very clear. People aren't going by, dropping over each other to get access to the dollar. It's just not what's happening. And the dollar DXY is telling that to you. The other thing that is showing that is the yields, right? So after the war started, the yields went up after correcting, it corrected a bit, but the yields generally went up. That is very strange behavior because people when things are about, when things are about to go bust, will buy the U.S. 10-year Treasury. That's just because it's a safe. It's classified as, it's a dollar. It used to be the dollar, the euro, and gold. Now the gold is, I'll talk about gold in a second. The gold now is above the euro, but this is very strange behavior and further confirmation again that the U.S. asset safe haven status is evaporating before our very eyes. And we saw it again in the February crash, we saw this, and now we're seeing it again in a geopolitical event with the Iran-Israeli war starting. Again, second confirmation. And to me, this is the nail in the coffin. There's no doubt anymore, right? We now already have the confirmation in the second order event here. And so keep that in mind, because that is a very big shift in how the market views it. When I'm saying the market is not the central bank, but the entire global market, how it views the United States as an asset safe haven. And it has changed. So I want to spend a little, the final moments here, because I do got to go celebrate my dad's birthday and take a time out here to talk to you guys, because these are pretty, important events happening right before our eyes. But, I do want to say that this is a potential issue, right? Now, I said the market internals were already pointing towards a correction, and we're going to find the news event to explain it away after it happens. And the news event turns out to be this Iran-Israeli war. But there is a financial thing we need to watch out here, because this is not the Ukraine-Russia war or the little spat that India and Pakistan had. This is Iran and Israel. The main thing that we are looking out for here is oil. Now, look, if you look at this chart, and you should know this, most of Iran's oil goes to China. Ever since the U.S. sanctioned the whole thing, most of Iran's oil goes to China, right? And now China has been very quiet this entire time. But, this could be a material headache for China if this oil supply, which we know now Israel bombed the Iranian oil fields, and now Iran's going to think about closing the Straits of Hormuz. So it's not just China, although China is going to be directly impacted because of its being the main, recipient of Iran's oil. But, if they close the Straits of Hormuz, or there's further escalation in the oil production and oil, route, from basically the Middle East to everywhere else in the world, we're going to have a spike in oil. And we already had a spike in oil on Friday, and it's likely that oil is going to continue to spike up higher. Now, I don't believe oil is in a secular bull market, right? So I do think oil is in a secular bear market, because we're probably facing a recession, stagflation, possible depression. So oil's probably going to shrink over time, but this is a geopolitical event, and oil is an asset that's very sensitive to geopolitical events like this. So we could see a huge spike, right, in oil, which I predict is probably going to come next week. And, the last time we had a spike like this was in 2008, when oil, I believe, went to $135 a barrel. And when that happened, people were unprepared for that. And if you recall, I don't know how many of you were trading back in 08, but when oil spiked to 135 back then, that resulted in pressure in the Japan yen carry trade. There was an unwinding in the yen carry trade back then that was triggered by the $135 shock of oil at that time. And we may have a very similar situation again here. Now, we had a yen carry trade unwind last year, and I believe it was in August or sometime towards the end of last year, that caused the markets to tank pretty hard. And we might be facing another financial plumbing type of issue here, where, an oil spike here, which it could go to 130. Look, if this escalates, we could even see something crazy like a $200 oil. Well, it won't stay at 200, but it could spike up to $200. And that kind of a spike could really cause financial plumbing issues, particularly with the yen carry trade unwind, because, if oil priced in yen gets so expensive, they're going to have to get oil through dollars. And then if the Japanese are going to buy oil in dollars, they're going to have to sell off their U.S. Treasury holdings in order to get the dollars. And if they sell off their U.S. Treasury holdings, that means the yields on the U.S. Treasuries are going to go up, which means mortgage rates. So there's this whole downstream domino effect, multiple streams of downstream domino effects that could transpire because of a shock in oil prices going up. And you could easily see $6 gas, not just in California, but all over the states. And you could even see $20 oil. I mean, look, in the 1970s, right, if you look at the OPEC oil shock that happened back then, and then you factor in inflation and calculate what prices in today's prices, like the OPEC shock would have been, it would be like $200 oil and $20 gasoline, and, you know, gas stations running out of gas, right? And that is something that is, I don't think is the main base case here. But if this thing continues to escalate, is something that is highly likely to occur if the escalation continues here. And we could see some shocks like that. And that would obviously derail the entire global economy and stock market and really push us down and really end this, you know, return to normal period in the bubble cycle, which I've been talking about in my previous episode. So having said that, let's see what the next week brings. Look, nobody wants war and suffering and death, right? Nobody wants that. Obviously, I don't want that. You know, we're just coming in from a point of view that the markets are overvalued and it's probably going to have a correction, that's a significant one, but nobody's wishing for war and death and suffering of people. So, you know, even though we do think the market is overvalued, we must, you know, keep in mind that we're talking about people's lives here, and that, you know, I honestly hope that this whole thing just somehow, you know, dies down and cooler minds prevail, and we find an off-ramp out of this, and we reduce and stop the pain and damage and death that may be on our way. So having that said, that, have a good, you know, Sunday, and we'll see what the next week brings. I'll probably be coming back to you from Singapore in the next recording. So until then, peace.